We keep saying it was a hawkish Fed, but it was a Fed that was pretty consistent. Powell said what he has said before, we are not done yet.
No, and as Caffeine and others are interpreting, it seems like the market wants to fade whatever the Fed says. And I think that is the big risk in 23, because although the Fed projection, which is absolutely worthless in my book anyway, but let's take it for what it is. You know, right now, as we talk, you and I, we have full employment in the U.S. We have financial conditions that are easier than when the Federal Reserve started increasing in an increment of 75 basis points. We have real rates that are massively negative. We have an inflation rate at a run rate, at a minimum, in my opinion, at 5 to 6%, because simply there is a rule among economists that the ceiling of one-year forward rates is really what the wages are tracking at. They're tracking at 6 to 7% in the U.S., so getting below 5 will be very difficult. So the real issue here is recession or not. Recession, I mean, I've been doing this job for 30 years. If recession comes with full employment, that'll be the first time in my career.
And of course, Powell has said that the labor market is still extremely tight. What is also surprising, Dean, is the projection, the dot plot for 2024. The range is tremendous, 3% to 5%. I mean, there's a risk that the Fed is wrong. There's no consensus on where we go from here.
There's no risk that the Fed is wrong. The Fed is always wrong. Fed has not foreseen anything in their lifetime. I like to say when I do speeches that I have a golden retriever. She's called Nellie. She's 9 years old. She's doing better than the 250 economists that works at the Fed. And she's done so throughout her life over the past 9 years. So there's no predictability in the Fed. What they are is exactly what they should be. They are data-driven. And I think the morning news from Australia is very interesting. You have a RBA who's been the first one to do the pivot on the pivot on the pivot. I mean, they must be spinning from all the pivots they're doing down there. But what happened to the employment number? The total employment went up significantly. You know, wait and see if that employment the impact is coming. I doubt it's coming. We have lost a lot of jobs in the U.S. due to long COVID. On top of that, you know, if I talk to business and I actually, you know, bother to actually talk to real people in the real economy, none of them are seeing the disinflation that's going on. It's all about inflationary, and the run rate is significantly above that headline that sits artificially inside the CPI. Remember, a CPI number is a consumer goods product. What you need to look at is really the PPI. It's broader in nature and it encapsulates the whole economy. That run rate is a north of 10% in pretty much the whole world.
One part of what you're saying, Steen David, here is that, to simplify things, the U.S. economy is doing well. And I would imagine there's probably a way to express that in an investment strategy, that bad news is not necessarily bad news for markets. How do you act on that information then?
No, so what I'm really doing right now is that I acknowledge that the medium and the long term is defined by the energy deficiencies and by the very tight labor market. So what we will see in terms of earnings, in my opinion, is that everything takes a lot more time than the market wants it to do. So, you know, in 22 for the Q3 and certainly for the incoming Q4, analysts were expecting that we see a significant compression of margins. I think that's the Q1 and the Q2 story. In 22, they were able to pass it on to the consumers. A little bit of a slowdown of the excess demand in the economy, not the recession, but the excess demand in the economy coming down, meaning the pressure on the earnings comes down. But who will do well in this environment remains the real economy. Logistics, defense stock, mining, energy, cybersecurity, and in my opinion, biotech continues to be the go-to. And what you want to avoid at all costs is very, very high valuations in the growth stock, simply because they are exposed to what we have discussed at length here, which is the terminal rate and the volatility of interest rate, which of course earns a model which is very high in cash and needs the discount rate to create the value.
Right. If you need that, that kind of tells you that there's no value there, right, Steen? There's a basket of growth stocks, to your point, that might be on the cheaper side. I'm talking China. What do you make of what's happening right now? What exposure do you want to China right now?
I find the whole conversation about China interesting because for the past 20 years I've used one indicator and one indicator only on China, and that is the credit impulse. The credit impulse takes all of the credit facilitation that goes on in the Chinese economy. That turned around not today, not yesterday, it turned around 6 months ago. So what we know from that is that with 60% R square, or in practical terms, 60% of what is going to happen in the economy in 6 months forward is already given, and that will be a higher level of activity. And then you add that the massive pivot that we've seen on the COVID-0 policy means that at a bare minimum, China moves from 70% capacity to 85 and 90. It may not get back to 100 before second half of next year, but there is an acceleration of the credit facilitation. And China being a controlled economy, a planned economy, there is no doubt in my mind, not only will they print higher numbers, but also the underlying trend will be relatively strong. Against that sits, on the negative side, which I think is that the doors on globalization is really closing down, and it's driven by China itself and by the US, the CHIPS Act in the US and the dual circular in terms of China. It is not a good story for global, but there we are talking about a 24, 25, 26 story.